Welcome back to CFI, Credit, Finance, and Investing. In today's video, we're going to look at a credit report. Actually, we'll look at several credit reports to give you a sense of how a credit report looks, what information's in a credit report, and how it may be interpreted by an underwriter. Now, I will tell you these are all sample reports. None of these are actual reports, and the information on them is mixed. These are generally I would consider them bad credit reports, or worse than the average American consumer would have. As we jump in, I do want to make sure that we talk about a few different things. So let's go ahead and just get started. Let me turn on the screen here. And as I mentioned, there are three different versions that we will look at. And what you'll find is there are many, many different versions of credit reports or configurations, layouts, things that a loan officer, an underwriter, or someone may have to look at when they're making loan decisions. This particular one comes from TransUnion. As you remember from some of the other videos, TransUnion is one of the three credit reporting agencies, which would be Experian, Equifax, and TransUnion. When we start looking at a credit report, the information that you'll see in here, and it's consistent as far as the information contained in a report. The layout, of course, is very different. These first two credit reports I will probably walk through rather quickly, just so you can see how the layout works. The last one is a Credco credit report. And that is a report that was consistent among mortgage lenders and underwriters that I have seen frequently. So it's a preferred format. So let's go ahead and look at this credit report. The first thing that you'll see is it's talking about the subscriber. The subscriber would be the company that is pulling the credit report. For someone to get a credit report, they have to have an account with a credit reporting entity or agency so that they can know that they are a valid requester or someone who's authorized to request credit reports. It'll talk about the input parameters, which you'll see here may have a reference ID, it may not, the social security number, name, address, that type of information. Something that an underwriter will look at is the date of the credit report. You will see in this video all of these credit reports are old, and that's okay. What this means, though, is when you're looking at the date, you'll need to relate that to all of the information that we'll be looking at in the report below. More on that here in a little bit. And then it talks about certain dates that things are reported. In credit reports, it generally will show the employment of the person who is being reported on. That's important when you're a loan officer or an underwriter because that tells you if the information reported to you on the application is accurate or not. If this information does not match, it's a red flag. It's not an automatic denial, but it is a red flag that they need to verify some additional information. It also generally will give the start and end dates of the person who's working there. As we're running through, you can see there's some other information like a ID mismatch. The current input address does not match the file address. That means the person doesn't live where they say they live on the loan application. Now, underwriters understand that people do move, but they may ask for some documentation, or they may use this to determine if someone's actually occupying a property that they say they're refinancing, or something along those lines. They may use this information to match up if someone is saying that they rented at a place, then that rent is one of their trade lines, and we've talked about trade lines, and we'll talk about that more here. But if they say they have rented at one address and the address of their current living quarters does not match here, that will require some additional information. On this report format, we go into credit scores next. You'll notice this only contains one credit score, and that is because this is only a TransUnion credit report. If this had all three bureaus, or if this was a tri-bureau report, you would see 3 credit scores here. This credit report, this particular one, gives a credit information summary. It talks about how many public records this person has. A public record is something that is filed literally through public records. That may be a lien, it may be a judgment, something along those lines. This person has 10 collections, 10 trade lines, and 12 inquiries. Now, the inquiry history will generally only go back, I believe, about 90 days. You'll also see that they've got the negative number of trade accounts with any historical negatives, and the occurrence of historical negatives. It talks about how many revolving trade lines this person has. And there's several different types of trade lines. In this instance, we would expect to see revolving, we would expect to see installment, we would expect to see potentially mortgage. Sometimes there's a monthly, there's a variety of different types. And then this talks about the closed with balances, how many accounts are actually closed but still have a remaining balance. Sometimes that can actually affect your credit negatively to have a closed account with a balance outstanding. There's a variety of reasons for that. One of them would be if you close an account with a balance, your available credit will come down to the balance, which means that your available credit looks like it's less on the credit report. So, pro tip, if you're going to close an account, make sure you pay it off first, then close it once the balance has zeroed out. And you may want to wait 30 to 60 days to give the company who has the loan time to report it to the credit bureau that it has closed with a zero balance as opposed to closed with an open balance. The next section on this particular credit report talks about the collections that are outstanding. And we're not going to go into them directly because we'll talk about that more in others. But you'll see this particular sample has quite a few collections. You'll notice there are a variety though, because it'll talk about the medical versus a bank. And if you remember from some of the loan underwriting videos that we have, the medical ones are not necessarily required to be paid off when getting a mortgage loan, but something here like HSBC Bank of Nevada at $434 may have to be paid off. It may not, depending on who the underwriter is. Sometimes there's a $250 limit, sometimes there's a $500 limit from what I've seen. And again, underwriters can make that discretionary call. This particular person, if I was an underwriter looking through here, I would see that they had some medical issues. In fact, if we look through here at the date, we've got 1/10/8/11, and this would be August of 2011 generally is what I'd expect that to see or to be. Here's 6/12, 7/11, 7/9, 6/10. So what I'm looking for here is, was this an isolated event? Did this only happen one time in the person's life? Do they have like a 90-day or 120-day window where maybe they had some medical issues and it was only that time in their life and everything else was clean? Or did they have a history of collections? Now we can see from this that this actually ran from 2009 to 2011. The date on this credit report, as we saw earlier, was 11/10, so 2010. Now this, remember I said this is a sample report, so it looks like in their sample building they actually carried this over to a year that was outside the scope of the report. But if we were to backdate that to 2010 when the report was open, we have several years, we have at least 2 years of this credit report of these collections happening, and most underwriters are not going to look at that as an isolated event unless you have something like a letter of explanation that draws a conclusion. If you have someone with a 20-year mortgage history and they have 2 years of issues and they're mostly medical during that time frame, that may be able to be tied together. In this type of an instance, a letter of explanation could be very helpful. Now the other piece of it though is we have a lot of varying credit items. So for example, we had HSBC Bank up here, then we've got medical, then we have Broad Street Trust, which there's no information on that. However, that is probably not a medical collection. We have Sprint, we have Progressive Insurance, Verizon. So it's not only medical bills that are being let go. It looks more like a consistent pattern of things being let go as we're going through. And that's what I'd look at as an underwriter. Getting into some other aspects, we've got judgments. We have a civil judgment from HSBC Bank from 5/07. Now this is where you start playing a little bit of a forensic detective or forensic accounting. If we look at HSBC Bank, this is actually from 2007 in the amount of $1,636. If I come up here to the open collection for HSBC Bank, it's $434. What I was looking for there is, could this be a judgment assigned to a collection agency? And in this case I would say no, because this balance amount here is much less than what the judgment was for. So chances are HSBC has lost money to this person twice. We have other judgments, Cornerstone Holdings and Ford Motor Credit. So Ford Motor Credit they obviously are a car financier. They lend a lot of money on cars. So this person, it looks like, has a history of having some financial issues, and an underwriter is going to have some concerns about giving them a further loan. Hopping into the other pieces on this credit report, this gets into the trade lines. And the trade lines are generally lines of credit that have been opened or they were opened in the past, and it shows their payment history. It gives you a lot of good information on this one as far as who the lender is, the type of loan. This is a revolving credit card, and revolving means it's open-ended. They can charge money and pay it off and charge money and pay it off, versus a car loan where you get the loan and you pay it off over time, but you can't borrow money out again without taking out a new loan. Information also here says it was closed when it was purchased by another lender. It tells you what the credit limit was. The credit limit was $300. Now this is something that's interesting on this particular credit report. The high credit was $434. Generally, in my experience, what this means is they had a limit of $300, but they spent more than that limit. The credit entity, HSBC Bank, said, okay, we'll lend you a little bit more money. But this is usually a negative flag on someone's credit report because it means they did not operate within the credit terms that they had been given. The balance is zero. The past due currently is zero, so they don't owe anything on this now. It was opened in 6 of 2010, closed in 11 of 2010, but verified 9 of 2011. Hopping down to Ford Motor Credit, and if you remember, there was a judgment for Ford Motor Credit. This was an installment loan because, again, you take out the loan and you make payments on it in installments, but you cannot continue to charge money against it like a credit card. It was an auto lease, so yes, leases are reported on credit reports, and it resulted in a profit and loss write-off, meaning they were not paid back the full amount and they had to charge it off, or they had to basically say, well, we're never going to get this money back, so we'll just write it off. The high credit was $13,579 for a term of 36 months. 36 months in the past was very common for car loans. They're getting more and more common to be at between 5 years and 7 years. The balance was $3,890 when it was charged off, and it was past due $3,890. Verizon, it looks like, was a telecommunications, so basically a cell phone. And a lot of cell phones do not report on your credit report, but in this case, because it went to a collection status, as you can see here, and the high amount on the collection was $1,118, they did report it on the credit report. It was opened in 2004, closed in 2011, verified in 2012. And then just continuing through, you can see you have a few more types of loans. A lot of these, it looks like, were paid as agreed, at least over time. USA Credit, a rating R1 means it was paid as agreed. Postal Government, this is a loan probably from a credit union. And this is where we start to get into some more of the payment patterns. Over here on the right hand side, you can see it shows months 1 through 12, and it shows all ones. What a 1 means is it was paid as agreed. 2 would be a 30-day late. 3 would be a 60-day late. 4 would be a 90-day late. So we can see how that played through on their car loan with Ford Motor Credit, where they had a 30-day late here, 2 30-day lates there. If you go back through the months 13 through 24, this customer had 30-day lates on their credit report 1, 2, 3, 4, 5, 6 times. So generally they would make payments. Sometimes they would make payments late. This will negatively affect your credit score fairly dramatically because it shows that you pay, but you don't necessarily pay as agreed. And if you come down here, let's look at the Chase. This was a revolving credit card again. Credit limit of $1,500, a high credit of only $143. It shows you the open, paid, closed, and verified dates, but it also shows that they had several paid as agreed, a 90, a 60, and a 30-day late. So they were paying as agreed, and so it goes in the most recent payment to the latest payment. So you can see that if they started back here, they were paid, 30, 60, 90, and then it dropped off. Now, if everything else on this person's credit report had been paid as agreed, this would be something that an underwriter may be able to come up with a good explanation for, or the borrower could explain to the underwriter by saying, well, you could see it was a $1,500 high credit. It was only $143 ever put on this card. That was the high amount that was ever put on this card. And situations that I have seen this happen is someone gets the credit card, and let's see, yes, it was only open for less than a year, it looks like. And they get the credit card, they don't realize there's an annual fee, and it goes 30, 60, 90 days late because they don't even bother paying attention to the credit card. Sometimes they don't even get statements, or maybe they have it on a email type situation. They email the statement, and the statement goes to a junk bin, and they don't realize that they missed their payment until someone calls them here when it's about to go to collections, and they automatically pay it, and then it goes back to 30, and then they close the account because they're mad at the account, and I would say justifiably so. So that would be a likely scenario for that particular trade line. And then you can see there's another one there. You get into the inquiry section, and we'll go more into this in another credit report, but these are all of the inquiries that they've had, I believe, in the past 90 days. Sometimes they will go back 6 months. Sometimes they may even go back a year. And on this particular one, it looks like they're showing us almost 2 years of inquiries. The address analysis, this talks about the inputting the credit file, or input current, so what they input when they typed in the information to request this credit report to the file address. It tells you no, they're not at the house, and it gives you some additional information here. And then it talks about who this report came from. You can see it's TransUnion and their contact information. So that is one type of a credit report that someone may see if they're looking at a credit, if they're looking at a loan, or if you request your own credit report from the credit agency, you may get something similar to this. However, they generally don't provide the credit score to consumers unless you ask for and pay for it separately. Now, this is a Kroll factual data. Factual data is a loan, or is a format that I used to see fairly frequently in the mortgage world that a lot of loan officers would use. And you'll see this is called a residential merged credit report. And what that means is you have all 3 credit reporting agencies on this report. You could have 2, but generally you'll see 3. It talks about where it comes from, client tracking, the requesting entity, the report number if you were to need to call factual data and ask for information to be modified or changed, which is possible, but again, it's done on a special type of credit report, but that would be the number you'd give them. It gives you the date requested and the time requested here. Applicant name, you'll see last name, first name, middle. You'll see a suffix if there is one, the date of birth, and the social security number for both borrowers. Coming down here, you'll see we have 6 credit scores, not the 3 that I mentioned, and the reason you have 6 is because you have 3 for each of the borrowers. You have Andrew and Kitty test case, and you have a middle credit score for Andrew of 545, and you have a middle credit score for Kitty of 589. And if you remember from one of our other videos talking about loan qualifications, currently they will average the median credit score. So you would take 589 and 545, add them up, divide them by 2, and that would be the qualifying credit score. You will also notice, though, that credit score falls in not a very good range, and because you're averaging those 2 scores, you will be below 580, and that means for a FHA loan, which would be your best option generally, unless you go with a non-QM type of a loan, a non-qualification type of loan. It used to be called subprime. They're staying away from that term these days. But you would not be able to go FHA up to the 97% or 96.5%, where you have 3.5% down. You would have to go a minimum of 10% down to even qualify for FHA. We're getting into the weeds a little bit. That's okay. So getting into the credit history, you'll see again that this shows the collections first. And this particular borrower has a few different types of collections. It does also show their payment history on these accounts as you go through. It gives you different, on this particular report, it gives you creditor information that you can tie back. So for example, we have American Express here. Here is American Express, so if there was a dispute on this, the loan officer or the borrower, if they get a copy of their credit report, and that is okay to ask for a copy of your credit report if you apply for a mortgage loan, you would be able to reach out to American Express and ask them for details on your credit report. So, and this is my mistake, as I was going through, I said this was the collections. They only have the one collection showing here. And then you can see over here it talks about the payment model that they've got. So on this particular account, they have a 360 month, $758 a month. What that means is they were paying $758 a month for 360 months or 30 years. If you look over in this section, this talks about different aspects: when the account was opened, when it was reported, the high balance, the high limit, and how many months it was reviewed. So this particular mortgage here, this was GMAC. GMAC also does a lot of car loans, of course, but General Motors Acceptance Corporation does a lot of home loans, and there are a few different entities that they have done home loans through historically. So this particular mortgage, let's take a look at this. That shows that they had, if you look here, this is the 30-day column. They had 3 30-day lates, 8 60-day lates, and 3 90-day lates. This is something mortgage lenders hate to see because it means that they are not getting paid back as they had expected. And you can see a trend on this particular one where you have Avco Finance. You had a high balance of $48.90 on a high limit of $5,000, so they were operating within the credit limits. It was reviewed for 20 months. Within that 20-month period, they had a significant number of lates. And it also shows you their approximate payments here. You had 36 months at $136. And you can see it continues through as we go through on those. The other information that you're going to see on this particular format, it'll talk about the general summary or the general summations of the credit report, meaning the oldest trade line this borrower had is 1294. They have 2 public records and 7 inquiries in the last 90 days. They also summarize the late payments, the total number of trade lines, the number of adverse trade lines or trade lines with problems, payment summaries, balances owed, and this aggregates all of the balances owed. And it talks about their monthly balance, their revolving balance, total installments, and total balance overall that someone may have owed. And then it talks about the amounts past due and the high balance or the high credit to balance that's available. If this particular one, if you were to see they had a revolving credit limit of $15,000 and a revolving high balance of $20,000, this person would be considered very overextended and having not lived within the balances that they were allocated by the credit companies, and that would hurt their credit score. The 2 public records that were shown on the credit report would be a judgment from 2002 for $18,345. It is paid, which would be good. If it was not paid, the lender would probably require that to be paid off before they would even loan on it. And the status date of 94. Then it also shows this person had a bankruptcy in 2002. Liabilities in that bankruptcy were $86,000. The assets were $78,000. This is the definition of being bankrupt. They were overextended beyond their assets. And the status shows filed. Something of concern to an underwriter in this status or in this situation would be the status showing filed as opposed to discharged. They may want some different paperwork on that, just to show, and it would be bankruptcy paperwork that would show that the bankruptcy had been discharged. This shows the inquiries, and in this framework we can see these are all within a 30-day period. As someone that would be underwriting a loan, I would expect the underwriter to think they are shopping for a loan, meaning they're going out and looking for different options that are available to them. That is not necessarily a bad thing. However, multiple inquiries can hurt your credit report. Now, if you look on the internet or if you do any research or if you even talk to the credit reporting agencies, they'll say that every inquiry will knock your credit report down by about 5 or 6 points. They will also tell you that if you get all of them within a 30-day period, it should only act as 1 inquiry. Now, whether that actually occurs or not seems to vary based on my experience, but if you do all of them within a confined time frame, it should not hurt you as much, as long as you're looking for the same type of loan, meaning if you're looking for a home loan and all of the inquiries are related to a home loan, that shouldn't hurt your credit score as much as if you have inquiries for home loans and car loans and credit card loans. All of those they may look at as someone who is extending themselves in a way that is not able to be sustained, or they're at least a higher credit risk. This one down at the bottom is where it gives you the employment information. We have Max Supply sales, Anderson Printing in sales, and BK Office Supply as an assistant. Generally, I would expect this to, oh, there we go. It shows you whether this is the borrower or the co-borrower. And then this one gives you a little bit of information on the risk score. This talks about the range being 0 to 50, and the higher the score, the lower the risk. So this person being a 10 out of 50, the higher the score, the lower the risk. It means the lower the score, the higher the risk. They would be considered a very high risk individual. Looking down further, it gives you some potential risk indicators. It talks about name and address matches, input from the phone number. This would be where the borrower lived versus where it may have been showed in the application information. It validates some social security information. And this is something that I have seen a number of times, where you have a social security number, it validates that it was issued during this time frame, and it may even say the person has been deceased, or it may say that they are reported in a different area than they currently are, and an underwriter will need some clarification on that. We have seen multiple social security numbers be used by multiple people. People can buy social security numbers from individuals who may not have authorization to issue a social security number. And then it talks about the information sources and rights, the borrower's rights, the applicant's rights under the Fair Credit Reporting Act, and what they're able to do. So those are two examples of different credit reports. And now let's hop into the one that I wanted to walk through, the Credco credit report, which is the more common format that I have seen used by many mortgage lenders. So Credco is a division of CoreLogic. This talks about the different types, or the type of credit report this is. Different entities will look at different reports. Landlords may look at a different one than a installment lender, which may look at a different one than a car lender. So this particular credit report, you can see, was received, the request was received on 7/10, so July 10th. It was completed on July 11th. It has some miscellaneous information that is important just for the person requesting the credit report. And it tells you the three different bureaus that the credit sources came from: Experian, Equifax, Experian, and TransUnion, and the charges that are associated. You'll see here this is 0. I would imagine that's because it's a sample credit report. Generally, a credit report can cost $60 to $70 or more if they're doing some additions or modifications to it. Obviously, you have the Social Security number. That's how most credit reports are tracked. And it gives you the age of the borrowers. It tells you the address of the borrowers, their marital status, and any number of dependents, and this information may or may not be accurate depending on what has been input into their file previously. It tells you the employer for both applicants, Berlin Tire and Acme Finance. And then we get into the accounts. And again, I'll say this person's credit is not the best. It's not very good, actually. And if someone was applying for a loan, this borrower would probably struggle, because when you look into their payment histories, they have a lot of late. So let's look at the joint accounts. Now, what this means is these accounts are joint. An underwriter would expect this to be joint between the applicant and the co-applicant. However, that's not a guarantee. An applicant can actually have a joint account with someone else. So like a child who is just getting into college, or someone who's just establishing credit, they may be on one of their parents' accounts. And we would want to find out the information on that. But for the sake of this, let's assume that this is the joint account between the applicant and the co-applicant. And this particular one starts out, and Credco generally will start out with the largest current account. So this is Bank of America Mortgage. It gives you the account number, but it does block out a few of the numbers just so that no one can steal these accounts or access them in an unauthorized manner. It tells you the bureaus, the credit reporting agencies that are reporting this: Equifax and Experian and TransUnion. It tells you the open date, the high credit, the current payment, and the balance. So this account has been open since 7/07. This credit report is from 2013. So you would expect to have several months of reporting, and you would expect the balance to have gone down. The method of payment, M-2, indicates that it is a mortgage that has 30-day lates. The current status shows you it is currently delinquent 30 days. That means they have not made a payment in over 30 days. Last reported on June of 2013. And then it shows you here under the 30, 60, 90 that they have 9 30-day lates, 1 60-day late, and 0 90-day lates in the history of the loan. This shows you the 12, actually it looks like it shows you the 24-month history, and you can see if you track back that they are currently down 30. Last month they were down 30. Before that, they paid as agreed for 4 months. Then they had a 30, paid as agreed 1 month, delinquent 2 months for 30. And going back here, you can see that they did have a 90-day late that has some distance between it. Now, this would be something that a lender would look at as a significant risk, because they have repeated lates, but not only do they have repeated lates, they are currently late. And they would generally want to see that current before they're considering making any sort of a loan. You can see here there is a Wells Fargo home mortgage. The open date was 10/08 for $40,000. Now, without going too far into the details, as an underwriter, you may make the assumption that this is a $147,000 mortgage. A year later, this is a $40,000 mortgage. This would probably be a second mortgage on their house that they've used to pull some additional money out. And on this particular one, they are paying that as agreed. So this would be a good trade line with no lates on 30s, 60s, or 90s, and they reviewed 56 months for that. So for some reason, they are paying this one as agreed. They are not paying that one as agreed, and that it's a great trade line. This helps their credit score, but it does make you wonder, why are they not paying their first, but they're paying their second? And then they have a Chevron card, probably a gas card. This account has been submitted to collections, and you can see it's only recently submitted to collections in May of 2013, and it was paid as agreed all the way through, and then it went 30, 60, 90, it went 30, 60, 60, 90, 120-day late, and then they submitted it to collections. I'd be very curious to know the details on this one, because it shows they have a zero balance. This very easily could have been some sort of an annual charge, or some charge that they were unaware of, and they didn't see their statements or just didn't look at their statements, and it went straight to collections. If everything else were clean or paid as agreed on this credit report, and this were an isolated incident, it may make sense for an underwriter to overlook it, or at least to give some leniency to it. You do also have a WFS Financial card that it looks like, or this looks like it probably is a car loan. It's an installment loan for $12,764, $285 a month payment. They paid this as agreed all the way through, or they're currently still paying it as agreed through July of 2013, 25 months reviewed with no lates. FNAB Best Buy. This would be someone who financed something when they bought it at Best Buy. Could have been a computer, could have been a drone, could have been a TV or stereo system or a refrigerator. And this particular one, it looks like they've had some issue making payments on time in the past. However, they are current based on the 6/13 day, the June 13th date. It does show you here that they have a number of lates. It shows you they have 3 90s, and it shows you the dates right there. It says they have one 60-day late, and it shows you the date of that 60-day late. 2 30-day lates with the associated date also. Let's get down into some of the others. You'll notice these were the accounts under the applicant, and then here we have only one account separate under the co-applicant, a Discover Financial Services, opened in 2008, paid as agreed for 52 months as of June of 2013. Now, if there was more credit depth that an underwriter may look at, is the only account under the co-applicant is paid as agreed. The applicant has an account not paid as agreed, and it may be able to be determined that the co-applicant pays their bills better or more on time than the applicant. Not that that will change anything, but if you're able to drop one party, meaning the co-applicant, if they can qualify by the loan for themselves, and you take the applicant off, and that removes all of the bad trade lines, that may be another method of qualifying for the loan. In this situation, we can see, though, all of the joint accounts have lates also, so that would not be a good option here. This possible non-applicant account, these are interesting. This is possibly an account that the credit report is saying it may not be the applicant's. We need to verify it, and there are ways to do that. But it is somehow being tied to the Social Security number. I've seen this happen in a number of instances. The most common way that I've seen this happen is if you have a father and or a mother that has the same name as their child. So if you have Joe Johnson as the father and Joe Johnson II as the son, that will frequently get picked up and tie into the credit report. Other instances, it could be credit fraud. If someone has used your Social Security number to open a loan, it will absolutely show up on your credit report and be held against you unless you can document that that was not your loan. This particular style of credit report then goes from the trade lines into the collection accounts, or the active loans into the collections. If there were a bunch of closed loans, it may show up in the section between these two. This particular one has a credit or a collection to Grant and Weber. It's a California Pacific Medical Services, so again, a medical collection. It looks like it's for $230, and it is joint. submitted to collections on 5 of 13. You're seeing a lot of these lates happening in the current time frame, somewhere between 5 and 7 of 2013. If, again, this were isolated, if it only happened at one time in their lives, you could point that to a once-in-a-lifetime type event, a medical issue, an accident, something like that, or maybe they lost their jobs. However, this borrower does have a significant history of having late, so it would be hard to make that explanation here. This section down here talks about the identification. It talks about possible non-applicant information. So Steve Sample, if that's a very common name, it may show you that you've got differing social security numbers. So right here you've got Steve Sample and Stephen Sample. The social security numbers are close. The dates of birth are off by a number of years. This could very easily be if you've got one born in June 3rd or on June 3rd of 72 and another one born on 7/31 of 85. An underwriter would ask for an explanation of who this person is. Are they related? Are they not related? Do they not know who it is? And then you can use that to eliminate accounts under this person's name. This shows inquiries in the last 90 days. Wells Fargo and Quicken Loans, both of these are mortgage lenders, so the entity may assume that they are out shopping for a loan. They're looking for different loan options. It shows you their prior address, 123 Eagle Road in Tomorrow, Oregon, and they'd lived there since July of 2011. It also talks about public record, and again, public record are things like bankruptcy, liens, judgments. This particular borrower has a Chapter 7 bankruptcy filed in February of 2008, jointly filed, and it is showing discharged. And if you remember the other credit report we looked at, it just showed filed, which generally would mean they're in the middle of it. However, that other one was old enough that if you give the discharge paperwork, they can get it taken care of and verify that it has been discharged and you're not in the active bankruptcy. Side note, if you're in an active bankruptcy, you are not allowed to take on additional debt because you're currently in the process of removing the debt from your name. And then, going back down a little bit more, it gives you AKA information. Frequently in this section, we'll see married women who have changed their last name show up with their maiden name. If you have someone who has used varying names for different things, and this can happen very easily in applying for car loans or credit cards, where maybe you have a formal name, maybe you have a Matthew and you go by Matt, or something along those lines. That will generally show up in this section. It also follows up on the employment information. It may show prior employers, so that if someone just changed jobs within the last year, generally a loan application wants to see a 2-year credit history or 2-year employment history, and you would probably see the prior employer show up here. And if the person has applied for credit with their new employer, or while they've been at their new employer, you would have both jobs here. And in this particular credit report, this is where you find the credit score information. So you have to dig a little bit. And what's interesting on this one is it only has a beacon score for the applicant at 536, but it doesn't have any of the other credit scores. It shows the co-application was not provided by Equifax. The TransUnion for the applicant does not match, and it does not show the other credit scores at all. So they're either saying there's not enough information to pull it, or they just won't score this individual because they don't like the credit profile. Again, remember, this is a sample report for this particular borrower. There is enough information to generate credit scores. I would expect them to have all 3 credit scores for both borrowers. Now, you also have the opportunity on some of the credit reports to add a consumer statement. And this could be like a fraud issue or fraud situation where someone stole your identity, or in this particular situation, the co-applicant says the account went delinquent or went to a delinquent status while I was out of the country. This is a consumer statement for TransUnion for the co-applicant, and that's for both, for Experian and TransUnion. Generally, you would have more of a statement here for TransUnion because you would have something like this for both Experian and TransUnion. And an underwriter will take this into account in certain situations. For this particular borrower, the underwriter will say, well, if you go out of the country, that's your problem, your responsibility to pay those bills, even if you're out of the country. An exception to that can be active military when they are assigned overseas in a conflict zone or some sort of a military conflict. Then there will be some grace given or some latitude given, and in fact, if you are in that situation, check with your creditors, because active active deployed military get latitude when they go overseas. Some decode information for creditors is here. And then you have some fraud verification. Now, people who have had their credit stolen or their identity stolen can put a fraud alert on their credit report, and that'll show up here. And then the underwriter is able to see, oh, this person has been a victim of fraud. Let's get some more details on that. What that will also generally do is if you flag yourself as a fraud victim, you can put contact information in this section where an underwriter will call you in order to verify you are in fact the person who is applying for a loan. Now, I have had personal experience with that, and it's not fun when you get a phone call from an underwriter asking you if you are applying for a loan on a car that you are not applying for. So they do check on this, and they generally will check on this. Sometimes they will not. So in my example, the underwriter at the bank called me because they saw a fraud alert. The car finance entity had told me when I called them after the fact that they figured the credit was good enough that they were just going to issue the car loan and not verify it. So it's a safety precaution, but it is not a catch-all. What you can do, just as a side note from this whole process, if you are a victim of fraud, you can freeze your credit, which means no one can even access your credit unless you unlock it. And we'll probably have another video on that. Down here, this gives a decode section to the credit report, but we've walked through most of this. So that is a Credco credit report, and in my experience, that is the credit report that most of the underwriting entities will use. So I hope this video has been useful. We've covered a lot of information on how a credit report is written, how it's drafted, how it works. If this has been helpful to you, please feel free to like it down below. If you have any questions or comments, put those down in the comment section. And if this has provided any valuable information, feel free to like, subscribe, and share with someone who may benefit from it. Thanks for being here.